Well, the market is still down 50 points. The Nifty is dealing with that cut. And while the bulls make up their mind about what to do next, let's welcome in our next guest on the show. Sunil Singhania, founder of Abakkus Asset Management, is with us this morning. Sunil, thank you so much for joining in. Always a pleasure having you on the show, especially when it's a Friday. The spirits are high, even though the market might be slightly down. But you tell us, Sunil, it's been a phenomenal rally. And up until this morning, the market has ignored all kinds of, negative cues from global markets, fear of more interest rate hikes in the US, etc. My question to you is that is a melt up a real possibility just because of the sheer momentum of liquidity that's coming in? Or do you think, the time is ripe to start taking some profits and maybe kind of get on the sidelines?
Thank you for having me, Surabhi. And obviously, it's always nice to have a good market. And obviously, it's very nice to be seeing Friday on the calendar. See, as far as liquidity is concerned, obviously, liquidity does aid markets. But liquidity can aid the market only for the near term. I think we have to also realize that it is also a function of the differentiating fundamentals which India as a country has been witnessing over the last couple of years. So, we always say that in 22, when the world was debating whether there will be a recession or 0% growth, in India, the debate was whether we'll grow at 6% or 7%. And we ended up growing at 7%. All the macroeconomic factors have turned out to be positive. The concern about monsoon is also allayed significantly, with the deficit being cut almost to negligible levels. And corporate profit generally have been pretty good. And the indications which we are getting from early, sort of numbers as far as June quarter is concerned, whether it was banks, advances, even now the jewelry companies reporting and even some of the consumer companies reporting clearly indicate that as an economy also we are in a very good position. And I think lastly, we should not forget the fact that, the crude is at $75. And that would mean that the balance of payment for India would have never been as good as it is today. So I think, yes, there is liquidity. And yes, there has been an uptick in the market, which has been very sharp over the last 3 months. But it is backed by fundamentals. And lastly, year to date, we are up like 5-6%. It's not that we are up majorly, So if you see 23, we are up like 6% on the Nifty. It's only from the bottom of March, we see that Nifty has moved up maybe 15%. But year to date, we are up only 6-7%.
Got that. We're still underperforming most of the emerging markets on a year-to-date basis in dollar terms. Sunil, morning, and thank you very much for joining in. This market is great if you're already in the market, right? You've already been investing systematically for the last couple of quarters, years. But for a fresh entry point, is this an attractive entry point, or do you think it's too overheated to get in? Because at the end of the day, even the price at which you enter matters.
So, you answered your own question. The moral of the story is that be invested regularly, irrespective of the levels, and you won't be disappointed. If you just look at timing the markets, I think you missed the bus in March because, the investors were too concerned about what was happening on Silicon Valley Bank and Credit Suisse and so on and others. And now, you're worried that markets have moved up. So, if you just keep on worrying, you will always be on the sideline worrying when to enter. Yes, we are also of the view that there is one pocket of the market, particularly on the smaller companies, which is overheated. There is definitely a fear of missing out, which is also creeping in. And one has to be careful. But, we are in the camp which would say that the market might react 3-5%, but we are not going to see a major correction. So I think if you're a fresh investor, maybe, you put in 25, 30, 40% of what you want to invest now and pray that you will get a correction.
Hi, Sunil. Good morning. Sunil, what about from the broader markets? We're still far away from that euphoric stage.
Nigel, what is euphoria? Euphoria is when P's become 30 and 40 at the Nifty level. We are at like 19 times, on the Nifty side. And at least our view is that for a change, the next 2 year earnings might see an uptick, which will be more than what we anticipate. So we are not in a euphoric stage as far as the market is concerned. As I said, some pockets, particularly smaller companies, are seeing that maybe scenario. But overall, at a overall market level, I think we are maybe 10% overvalued, but not definitely in a euphoric stage.
Okay. So, Sunil, you've made it pretty clear that you find this rally to be qualitative. You're looking to remain invested. So let's come down to the areas. If someone's going to put fresh money to work now at these levels, at these all-time highs, then where do you look? Autos have had a great run. Banks haven't performed that much. I mean, just comparative to the Nifty. Then there is IT, where there's general sort of bear camp congregating. So broadly speaking, which are the sectors where you think fresh money can be put to work?
So, I don't think my views are going to change from the last time I mentioned to you and the previous. I think it remains the same. The other thing is, India is a country which is very diversified. We have presence across sectors. We have entrepreneurs who are at work, again, across sectors. And, unlike, market performances definitely don't mirror the views. So, you mentioned about IT, that, everyone is definitely a little bit sanguine about IT, which is rational also given the slowdown which we are seeing. But actually, if you see year to date, some of the IT stocks have been great outperformers. So, a lot of times the view on the sector is already discounted as far as the markets are concerned, both on the positive and the negative side. We are definitely in the camp which believes that banking should start to perform. And it's a good 2-3 year play. Credit growth has been very strong, and the initial numbers announced by most banks clearly point to almost 18 to 20% growth in advances. NPAs are non-existent. Yes, there has been a little bit of increase in interest rates, but I think that is more or less factored in. And from here on, we might see some relief as far as the interest rate is concerned. At least we are in that camp. So I think financials obviously look pretty decent. We are also of the belief that discretionary spend should pick up. April to June was not great. But, come the festive season in the second half of the financial year 24, we are very optimistic that discretionary spend will pick up in a major way. And I think that is where we are invested. Capital goods, again, is a great theme, great sector, though the stocks are not very cheap, so one has to be very careful. And in a very small theme, I think steel is something which we like selectively, though China has not been growing the way people expected post the reopening of the economy. But I think steel is one place where we believe that Indian companies have great moat. Their integrated balance sheets are very clean. So in a small sector, I think steel will be something which we would look at. Pharma, looking at it, not jumping into it. But again, valuations there are now much more reasonable than where they used to be.
Why are you not jumping into pharma as yet? What's keeping you on the sidelines?
So pharma, as a sector, obviously has become cheap, but stock specific, one has to be very careful because, there is a enhanced sort of scrutiny as far as regulatory issues are concerned. And you don't want to get stuck because we have seen that even a small regulatory news flow leads to like a big move up and down as far as pharma is concerned. So we are equal weight. We have not gone overweight, but there are some companies which we believe will get an opportunity in the next 3-4 months.
Sunil, what about the railway theme? That has played out very, very well. And I think you all latched onto it very, very well as well. A couple of stocks are on public domain as well. Titagarh Wagons, I think. So how much of the good news is in the price for this entire railway theme? Because it's got a long runway. The kind of moves that we're seeing from the government of India as well, the kind of importance that it's being given. So your view on that space, capital goods we got. What about the railway theme?
No, I think railway is again something, there is a lot of spending happening. In fact, I traveled by the Vande Bharat for the first time 10 days back and I was pleasantly surprised. And we had some exposure, but Nigel, very frankly, we could have had more than what we had. But we also did not anticipate the kind of ordering which we saw as far as this sector is concerned and will continue to be in this sector. So we are having some exposure. We are also looking at some indirect ways of playing this theme. I think there is a huge tailwind, and I would say that remain invested. Though some of the names which you mentioned, I think now a lot of what is going to happen over the next 2-3 years is sort of already discounted.
So at the index level, you're saying we're probably overvalued by 10%. But where are the pockets where the overvaluation is far more, where valuations have run ahead of fundamentals and you're uncomfortable?
So, as a fund house, we are very value conscious. So there are a lot of sectors where we are uncomfortable, but being uncomfortable does not mean that the price will fall, right? So there are investors who are willing to take that call of 4-5 years of rapid growth, and there is justification, maybe, for companies which have moved up quite sharply. So we tend to, Reema, stay away from fashion or themes. We are, I would say, slaves of numbers. So wherever the valuations are 50, 60, 70 PE with growth of only 10-15%, we tend to be a little cautious. But where there is growth of 25-30% expected, we don't mind paying even 30-40 PE multiples. So, it's very simple, just look at the valuations and the growth rates. I think if the valuations are like 4-5x of the expected growth rates on an annual basis, I think those are the sectors, theme stocks, which we will stay away with.
Okay, all right. Sunil, a final question before we let you go. What about IT? There's a debate out there in terms of how to approach this space. There are a lot of risk, but I'm looking at some smaller stocks. They're up 20-25% from the recent lows as well, after correcting a goodish bit from mid-cap IT. How are you all approaching this theme? Stay away, or do you still believe that someone who wants to buy it for a little longer duration, they should be getting in if in case things get a little rocky?
So, Nigel, I've seen the market for a long, long time. And, when the market scenario and sentiment is good, there are investors who wait for negative news to latch into it. And therefore, we are seeing that even on negative news flow, stocks are not correcting, because right now the mood is towards investing in India from a 3, 4, 5 years perspective. And it's not only local investors, even global investors. I have been traveling across the world in the last 2-3 months. Our theme of dragon to elephant is for real. We are seeing money definitely look at India and away from some of the other larger countries. In IT, yes, June numbers might not be that great. Maybe September also, I don't know. But valuations have been pretty decent for some of the larger companies. You don't get 100% cash conversion companies who distribute 80-90% of their profits available at sub 20p. And that's the reason why they've been consolidating. And some of the smaller IT companies continue to grow much faster because they are in niche segments. So I would say that, it's a sector where India has global competence. But at the same time, I do agree with the view that June and September quarters might not be that great. But, at decent valuations, I think this is a sector which can be a good part of your portfolio and which can be a good, like a 15% compounding kind of a sector.
Always good hearing your thoughts. Sunil, thanks so much for joining in and filling us in with your views on the markets as well as the individual sectors that we discussed. Wishing you a good Friday ahead.